Welcome to today's Explainer. We're jumping right into some incredibly revealing insights pulled directly from the Fintech Stack's daily briefing for Thursday, May 14th. Today, we're going to look right past those flashy corporate headlines and the buzzing 24-hour news cycles. We want to see how money is actually moving right now. Because honestly, while the mainstream media is completely fixated on the glitz and glamour, the real architects of our financial future are quietly building an absolute on-chain financial revolution behind the scenes. Let's dive in. You know that classic scene in the show Succession? The one where all the VIPs are on a private jet flying off to some incredibly consequential meeting, but the actual massive power moves are happening quietly down on the ground? Well, that is exactly what today's financial landscape looks like. On one hand, over in the noise column, you've got Air Force One touching down in Beijing. You've got Donald Trump, Elon Musk, Jensen Huang, Tim Cook, and all the top brass from MasterCard, Visa, Citi, Goldman Sachs, and BlackRock. It's literally the most star-studded trade delegation we've seen in nearly a decade. But look over at the signal column. While the whole world was watching that plane land, three massive structural shifts happened right under our noses. JPMorgan, BitGo, and Apex just quietly pushed through some major upgrades to the fundamental plumbing of modern finance.
All right, Section 1, JPMorgan validating public blockchains.
Our first stop is the biggest traditional finance name in the world and how they are completely, undeniably validating public blockchains. $100 million. Let that sink in. JPMorgan Chase isn't just sitting in some isolated lab testing tokenization anymore. Today, JPMorgan Asset Management officially launched JLTXX. That's the JPMorgan On-Chain Liquidity Token money market fund. Now, this is their second tokenized money market fund, but here is the absolute game changer. It's their very first one available on the public Ethereum blockchain. And they didn't just announce it for PR. They seeded it with a cool $100 million right at launch.
Now, you might be wondering how exactly this thing works. The mechanics are super interesting. First, Anchorage Digital is co-participating. The fund invests exclusively in U.S. Treasuries and overnight repos, paying out through daily dividend reinvestments. But here's the kicker. It allows subscriptions via stablecoins under JPMorgan's Morgan Money platform. Why do that? Because it's explicitly designed to serve stablecoin issuers who are operating under the new Genius Act. You know, that stablecoin regulatory framework that just became law earlier this year? They're literally custom building a compliant, perfectly tailored vehicle for the next era of digital cash. And to put this into perspective, just look at the wider market. $30 billion. That's the total value of tokenized real-world assets sitting on public blockchains today. On-chain assets under management have nearly tripled since early 2024. It's growing like wildfire. JPMorgan's first tokenized fund, Money, was just a private placement for qualified investors. But JLTTX, it's registered, it's public, and it lives natively on Ethereum. This is a massive leap forward.
So the absolutely crucial takeaway here is this. The chain is no longer the experiment. It's the product. This isn't just some incremental software update. When a powerhouse like JPMorgan drops $100 million on-chain and officially labels it infrastructure, you better believe the rest of Wall Street takes notes. The era of treating the blockchain like a quirky, futuristic experiment, it's officially over.
Moving right along to Section 2, BitGo, finding the stablecoin signal.
So, if JPMorgan is providing the shiny new investment vehicle for stablecoins, someone else has to actually provide the foundational custody. Enter BitGo. We're looking at their Q1 2026 results, which is their very first full earnings cycle since going public on the New York Stock Exchange. On the surface, man, these numbers look incredibly complicated. Total revenue is a massive $3.8 billion, up 113% year over year. Client count surged 42% to over 5,500 institutions. Sounds like an absolute home run, right? But then, you look down a row. Net loss hit $60.7 million, and adjusted EBITDA swung to a loss of $1.7 million. What in the world happened? Well, it's a messy mix of mark-to-market Bitcoin hits, heavy IPO-related stock compensation, and some really bizarre derivatives accounting quirks. Basically, it makes the whole revenue comparison look a lot less like apples to apples. But hey, we never just look at the headlines, right? We have to look at the fine print. Let's peel back the onion here and look right past that surface-level net loss to find the true narrative.
Boom. The real signal is buried deep inside their business lines. BitGo's stablecoin as a service revenue jumped 43.6% sequentially, hitting $38.2 million. CEO Mike Belshaw actually pointed this out specifically, calling it an emerging area that will absolutely define the next phase of digital finance. Meanwhile, their normalized assets on the platform, meaning when you strip out all those volatile crypto price swings, grew nearly 30% year over year to $63 billion. BitGo has been the institutional custody backbone since 2013, but now, as a public company, they're reporting massive, dedicated stablecoin revenue lines. And if you need absolute proof that this is real, just look at this number, $4.4 billion. That is the amount of stablecoin holders' deposits currently sitting right on their balance sheet. This isn't some theoretical projection. This proves, without a doubt, that stablecoin infrastructure generates real, undeniable, massive revenue today.
Okay, let's hit Section 3, Apex and Plaid, fixing the brokerage nightmare.
We're going to shift gears for a second from crypto plumbing to traditional brokerage plumbing. Because while institutional money is getting a sleek on-chain upgrade, consumer transfers are finally getting a desperate, long overdue upgrade off-chain. Let me ask you a question, and apologies if this triggers some bad memories. Have you ever actually tried to move a brokerage account from one firm to another?
Yeah, it's an absolute nightmare. The legacy AAC-CATS transfer system, which is the literal plumbing that moves your stocks and cash between brokerages, is notorious for ridiculous delays, random rejections, and manual errors. Honestly, using it feels like you're faxing paperwork in 2026. It has been fundamentally broken since the days when AOL was relevant.
But look at how Apex Fintech Solutions and Plaid just teamed up to completely fix this. They've combined Plaid's massive account connectivity, which already links over 12,000 financial institutions across the US, Canada, and Europe, with Apex's deep ACATS infrastructure. And they packed all of that into one single API endpoint. It automates the account linking, instantly validates the data, seamlessly triggers the Apex transfer, and actually gives you a unified audit trail with real-time status updates. No more guessing where your money is. And you have to understand, the timing of this is everything. We are in an era of unbelievably intense brokerage competition. Robinhood, SoFi, Chime, they're all in a vicious dogfight for your wallet share. When the competition is this hot, the winning strategy is simple. Whoever offers a frictionless transfer experience wins the switching war. If you make moving money instant and painless, you can seamlessly poach accounts from legacy brokers like Fidelity, and you can do it without spending a single dime on marketing. Apex and Plaid just handed modern brokerages the ultimate weapon to win that exact war. Let's wrap things up with Section 4, the new Wall Street plumbing. So, let's bring all these threads together. When we zoom out, what exactly are we looking at here? We are looking at a complete top-to-bottom rewiring of modern finance. While the whole world was totally distracted by the noisy geopolitical headlines and star-studded CEO delegations touching down in Beijing, the real work was quietly getting done. JPMorgan effectively put the U.S. Treasury on chain. BitGo proved beyond a shadow of a doubt that stablecoin infrastructure is a real, deeply profitable revenue line. And Apex and Plaid finally made switching brokerages as easy as it always should have been. I want to leave you with one final, pretty provocative thought. Who actually wins when your money moves freely? I'll tell you this much. The blockchain buzzword era, it's officially dead. The companies surviving today aren't selling hype anymore. They are building pure utility. The infrastructure era is finally here, and the companies controlling the plumbing are the ones who are going to control the future of your wallet. Thank you so much for joining me for today's explainer, and remember, always keep your eyes on the signal, not the noise. Catch you next time.